The quiet apostle of return on equity. What beginner investors can learn from George Michaelis. Imagine you're at a party. Everyone is talking about the hot stock that doubled in a month. Someone just made a fortune on crypto. Another person is bragging about buying a meme stock before it exploded. Now imagine George Michaelis at that party. He's standing quietly in the corner, holding a glass of water. He's not excited. He's not bragging. And yet, over 15 years, he turned every $10,000 into $130,000, while the rest of the market turned it into $50,000. He did it by being boring. He did it by being patient. And he did it by never forgetting one thing. The 100-year storm is coming. Let's learn his story and his rule. Part 1. Who was George Michaelis? George Michaelis was born into chaos. His Jewish family fled Russia, then Germany, then Belgium, then France. His father died 2 weeks after they reached America. George was 4 years old. He wanted to be a painter, but he was good at math. So he became an engineer, then went to Harvard Business School. Later in life, he regretted not studying history and philosophy. He buys books on those subjects but never has time to read them. They pile up in his house. He is medium height, dark complexion, with a neat mustache and thinning black hair. He speaks in a warm, deep voice. He met his second wife on a ski trip. A normal man, but a remarkable investor. Part 2. How he got started. From disaster to opportunity. In 1968, a fund called Source Capital was run by a gunslinger named Fred Carr. Carr gambled on risky, unproven stocks and private deals. When the market crashed in 1969-70, the fund collapsed. In 1971, Michaelis was brought in to clean up the mess. By 1977, he was in charge. What happened next? Over the next 15 years, Source Capital returned 3 times the S&P 500. A $10,000 investment grew to $130,000, while the market gave you $50,000. Only 5% of all funds did better. How? Not by being a gunslinger. By being the opposite. Part 3. His golden rule. Survived the 100-year storm. Michaelis' most famous quote, "You must invest with the 100-year storm in mind. It is most unlikely to occur, but one has to survive if it ever does." What does that mean for a beginner? It means, don't risk everything on a sunny day. Michaelis always kept cash. Lots of it. At least 10% of his fund was in cash. Before the crash, he was 20% in cash. In mid-1988, still 18% in cash. Why? Because when the storm hits, cash lets you buy bargains. And more importantly, cash keeps you from being forced to sell at the worst possible time. Beginner takeaway: keep cash. Even 10% or 20% feels like a drag when markets are rising. But when markets fall 30%, that cash is your lifeline and your ammunition. Part 4. What he looked for in a company. The 3 filters. Michaelis didn't gamble on hot tips or turnarounds. He only bought companies that passed 3 simple but powerful tests. Filter 1. High and sustainable return on equity, ROE. ROE tells you how much profit a company generates from the money shareholders have invested. Michaelis wanted 20-30% ROE year after year. But here's the key. He didn't just look for high ROE. He asked why it was high. Is there a moat? Economies of scale? A unique dealer network? Patents? If he couldn't explain why the ROE was high, he didn't buy. Example: Kellogg controls 40% of the cereal market, 2.5 times larger than its nearest competitor. That scale means cheaper advertising and manufacturing. Even if Kellogg messes up for 5 years, it just loses a little market share. Profitability stays strong. Example: Melville, 24% average ROE for a decade. No obvious barriers to entry, but incredible management. Generated $2 in cash from a $350 million base I. Filter 2. Very low debt. The average S&P 500 company has debt at 25% of total assets. Michaelis companies average 15% debt. High-profit businesses generate so much cash that they pay down debt naturally. That creates a margin of safety. Beginner takeaway: debt kills companies in a downturn. A profitable company with low debt can survive 2 bad years. A highly leveraged company can go bankrupt in 6 months. Filter 3. Earning power not tied to the business cycle. Michaelis avoided companies that boom in good times and crash in bad times. He wanted steady, predictable earners. Insurance adjusters. Tax preparation. Cereal? Thoughts I. Shoes I. Tread rubber. Boring. Yes. Safe. Yes. Part 5. His variation on Benjamin Graham. Buy earning power at a discount. Benjamin Graham, the father of value investing, said, buy assets at a discount. Michaelis refined that. Buy earning power at a discount. What does that mean? You don't just look for a cheap stock. You look for a great business whose earning power is temporarily undervalued by the market. Example, IBM. Even in a poor year, IBM earns 20-25% on equity. It has more cash than debt. It's so much larger than rivals that it spends on R&D far more effectively. In the mid-1980s, IBM had a profit squeeze because mainframe growth slowed. But the earning power was still there. Michaelis bought at around 10 times earnings. That's a bargain for a world-class business. Example, Marsh & McLennan, the world's largest insurance broker for Fortune 500 companies. Tollgate business. Michaelis estimated earnings of $4.05 per share, moving to $7.09. He said, one of these days the stock will jump so fast you wouldn't be able to move in time. It's best to own it now and wait patiently. Part 6. How he bought. The target price method. Michaelis followed about 300 companies. He set a target price for each. When the stock fell below target, he started buying. The lower it went, the more he bought. He never expected to buy at the exact bottom. He knew he might start buying too soon, but he hoped to still be a buyer when the bottom finally arrived. Beginner takeaway. You cannot time the exact bottom, but you can buy in stages. If a stock you love falls 20%, buy a little. If it falls 30%, buy more. If it falls 40%, buy even more. That's called scaling in. Part 7. How he sold. The singles hitter. Michaelis called himself a singles hitter. He didn't try for home runs. He sold when a stock became moderately overpriced. He knew he sold too soon sometimes. He made peace with it. Example, H&R Block, a wonderful business. No inventories, no receivables, no fixed asset. But no way to grow fast. Michaelis sold at 25. Tirasikirai. The stock might have gone higher. He didn't care. He took his single and moved on. Beginner takeaway. Greed is the enemy. If you sell too soon, you leave some money on the table. If you hold too long, you can lose everything. Michaelis preferred the first mistake. Part 8. What he avoided. Derivatives, themes, and high debt. Michaelis distrusted fancy financial products. Options. Hunts. Futures. Hedges. Collateralized mortgage obligations. CMO story. He said, I see as many people failing because they are too smart as because they are too stupid. Clever people fall in love with clever ideas. Clever ideas blow up in a crisis. He also avoided investing in themes like Americans are getting older. So let's buy. He grinned when the author suggested crutches businesses. Themes are too vague. He wanted specific businesses with specific numbers. And of course, he avoided high-debt companies like the plague. Part 9. His bond strategy. 2 extremes, no middle. Most investors buy medium-quality bonds for a little extra yield. Michaelis refused. He said, either buy the safest bonds, governments, or buy distressed bonds that are mispriced because of bankruptcy fears. Example, Texaco bonds. After Texaco declared bankruptcy, Michaelis bought its bonds. He made 40% in 1987, while the stock market fell 30%. Example, LTV Steel. The day LTV went into Chapter 11, Michaelis bought bonds secured by a top steel plant. They recovered to full value. Beginner takeaway: you don't have to do this as a beginner. But the principle matters. Avoid the muddy middle. Go for safety or go for deep value with a clear catalyst. Don't pay a little extra for a little more risk. Part 10. The mistake. Even masters miss things. Michaelis bought Rohr, an aircraft parts company with 90% of its market. Dated. No debt. Big cash pile. What could go wrong? He missed that Rohr was at the end of its programs. Cash flow was high temporarily. Then the business changed. Rohr had to take on more risk in longer-term projects. Its negotiating position was weak. The cash pile disappeared into negative 150 million cash flow. Michaelis sold with only a small profit. Beginner takeaway: you will make mistakes. The goal is not to avoid all mistakes. The goal is to keep mistakes small and learn from them. Part 11. His views on honesty and management. Michaelis noticed something interesting. Sometimes voting stock, with control, trades at a high premium because investors expect management to abuse power. Sometimes voting stock trades at a discount because investors trust management. Boy. Example 1. Donald Trump. Voting stock traded at a premium. People expected him to take advantage. And he did. Example 2. Brown-Forman. Voting stock trades at a discount. People trust management to be fair. Michaelis preferred companies run with the old-fashioned Protestant work ethic. Management that owns a lot of stock, has been there a long time, and treats shareholders as partners, not as prey. Part 12. The problem with performance monitoring. In Michaelis' time, consultants started rating fund managers against normal portfolios. Big caps, small caps, growth, value. Michaelis called this a consultant's dream, because consultants could change the rules anytime and keep clients locked in. He said, "They tell you how you would do if the future were the same as the past, but it won't be." Beginner takeaway: don't chase past performance. Don't let short-term ratings drive your decision. Invest in businesses, not in backtests. Part 13. His final advice for investors, from 1988, still true today. At the time of the book, Michaelis observed: 1. The market was selling at twice book value and yielding only 3%. 2. In the 1970s, you could sell one undervalued stock and buy another. Today, 1988, that was much harder because so many investors were chasing the same good stocks. 3. Therefore, selling too soon is a bigger sin today than it was. His solution: find coffee can stocks, a term from Robert Kirby. These are stocks you can put away for 5 years, ignore, and trust they will grow steadily. His specific recommendations at the time: Kellogg, Melville, Bandag, Marsh, and McLennan Crawford, Bristol Myers, and IBM. He warned against investing new money in any company with significant exposure to a recession. And he reminded everyone, plant utilization was at an 8-year high, unemployment at a 14-year low. That environment cannot be considered risk-free. Final lesson for beginner investors. George Michaelis was not a genius. He was not a gunslinger. He was not a daredevil. He was a man who knew one thing about himself. He had a low tolerance for risk. And instead of pretending otherwise, he built an entire investment philosophy around that truth. He held cash. He bought high-ROE, low-debt companies. He bought them at discounts. He sold them early. He avoided clever derivatives. He bought distressed bonds when others panicked. He made mistakes but kept them small. His greatest gift to you, the beginner investor, is this: you don't have to swing for the fences. You can hit singles. You can survive the 100-year storm. And if you do both over time, you will beat almost everyone. Be boring. Be patient. But be safe. And let the gunslingers destroy themselves. That is the quiet wisdom of George Michaelis, the apostle of return on equity.